You walk into a bank, paperwork signed, mortgage approved for $300,000. The banker doesn't reach into a vault. He doesn't call another customer's account. He simply types. And just like that, $300,000 that never existed 5 seconds earlier now sits in your account. This isn't a glitch. This is the system. Banks don't lend money. They create it. And every house, every business, every paycheck you've ever touched is built on that quiet act. Why should you care in February 2026? Because right now, the world is carrying more debt than at any point in history outside of wartime, over $348 trillion globally. The U.S. money supply alone sits at $22.44 trillion, almost all of it electronic deposits created by commercial banks. Your rent, your car loan, the government's ability to keep the lights on, everything depends on banks continuing to create this money. But the moment they stop or can't, the money literally disappears. That's not exaggeration, that's accounting. And that reversal is exactly what nearly brought the world to its knees in 2008. Today, the stakes are even higher. So let's walk through exactly how this works, step by step, without the textbook fog. Forget what you learned in school about banks taking your savings and lending them out. That's the first myth. Here's what really happens when you apply for that $300,000 mortgage. The bank looks at your credit, decides the risk is acceptable, and approves the loan. At that exact moment, two entries appear on their balance sheet. On the asset side, a new $300,000 loan owed to you by them. On the liability side, a new $300,000 deposit credited to your checking account. New money, created instantly. You haven't received anyone else's savings. The bank has simply expanded its balance sheet. You write the check to the seller deposits it in their bank. Their bank now has $300,000 more in deposits. The original bank loses $300,000 in reserves when the payment clears through the central bank system. But the central bank always supplies whatever reserves are needed. Reserves don't limit lending. Demand for loans and the bank's own risk appetite do. When you pay the mortgage back over 30 years, the reverse happens. Each payment reduces the loan asset and destroys the corresponding deposit. Money is deleted. That's the engine. Loans create deposits. Repayments destroy them. The Bank of England put it plainly in 2014. Anytime a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. And commercial banks do this for roughly 80% of all the money we use every day. Physical cash is just 3%. Central bank reserves are another slice. The rest? Bank-created electronic money. Now, the quiet irony. Banks earn interest on money they created out of nothing. They charge you 6% on that $300,000 they never had before they typed it into existence. They don't create wealth, they create claims on future wealth. But because they get paid interest on those claims, their incentive is to keep creating more, as long as borrowers can service the debt and regulators allow it. The system only works as long as new loans keep coming. Stop the flow and the money supply contracts. That's not a side effect. That's the design.
Walk into any bank branch today and the posters still say, "We lend your deposits." Textbooks still draw the old money multiplier diagram, where reserves magically multiply into 10 times more loans. Politicians still talk about printing money as if only central banks do it. The reality? Central banks set the price of money, interest rates, and backstop the system. But the actual creation of the dollars and pounds we spend, that power sits with commercial banks. It's one of the most successful sleights of hand in modern finance, and it stayed hidden in plain sight until central banks themselves started explaining it. Scale this up, and you see why it powers the entire economy and why it can break it. Credit booms inflate asset prices, houses, stocks, everything. Credit contractions destroy them. In 2008, banks stopped creating new money and started demanding repayment. the money supply shrank, businesses folded, homes were lost. In 2026, the backdrop is even more fragile. Governments, corporations, and households are all carrying historically high debt loads. The system now requires constant credit expansion just to service the old debt. If banks become cautious, higher rates, tighter regulation, or simply fear of defaults, the money creation slows, spending falls, unemployment rises, tax revenue drops, governments borrow more, which requires still more bank-created money. It's a loop, a powerful loop when it expands, a dangerous one when it contracts. And here's the deeper tension. Who gets the new money first? The big corporations, the wealthy homeowners, the connected. By the time it trickles down, prices have already risen. That's not a bug. It's how the mechanism distributes purchasing power. So the next time you hear the banks are lending, remember, they're not lending, they're creating. The entire global economy runs on trust in that creation process. Trust that borrowers will repay. Trust that regulators will keep the system stable. Trust that the next shock won't freeze the machine. But trust is fragile. And in 2026, with more debt than ever before, that fragility matters more than most people realize. What happens the day the creation slows? The answer is already written in the balance sheets. The question is whether we're ready to read it.